To remain updated with the latest business news, click on the bell icon.
Hello and welcome. You're tuned into Business Today. I'm Sakshi Patra. Well, the stock markets have been very, very volatile of late. And what should investors be really doing at this point in time? What's the best way to beat this volatility in the current environment when you're bogged down with geopolitical concerns? There's rising inflation, the crude oil prices, on the other hand, the worst thing, macro headwinds at this point in time. How do you best navigate through all of this? That's going to be the focus of this discussion. I'm going to be joined by a very, very special guest. I have with me Mr. Ambarish Paliga, who's a market veteran, joining right in. Thank you so much for speaking with us and sharing your thoughts with us on this show. Good to have you with us.
Thanks, actually, it's my pleasure.
So let me begin by asking you, first of all, how are you looking at the current market scenario? Now we have amid the war, the rising crude oil prices. I want to understand, is the worst already priced in behind us? And with respect to valuations amidst the recent correction, how do you see the markets?
See, in fact, the markets had got a bit too frothy with the amount of retail liquidity which was coming in. And in fact, I was suggesting people to get into cash to a large extent in the last couple of months. And possibly this war acted as a catalyst. And this actually helped the markets correct to a very large extent. But then, have the markets become attractive at these levels? Yes, I think it's become cheaper. But I don't think it's yet too attractive because I still see a further correction from here. The reason being that, yes, like we are hopeful that the war will get over sooner than later because clearly Ukraine president has thrown in the towel, agreed to whatever demands Russia had. So hopefully sooner or later the war will get over. But with that, possibly we can have a bounce back, which could be more sentimental, like what we have seen in the last 2 days. One was because of the election results, and second, because of the expectation of the war getting over. But then with that, do the wars get over? No. I think this is just the beginning because with the sort of sanctions which have been put on Russia, again, I would say Russia is not Iran. So with the sort of sanctions which have been put on Russia, I think this will clearly create major issues with the supply chain.
Okay. And so how much downside do you see from here, since you say that there could be some more?
The downside, it's very difficult to pinpoint. But then I can say that either 10% fall from here, I would possibly be more comfortable with the valuations because no one really can call the bottom. But at those levels, I would be more comfortable investing the cash which I'm sitting on, which we've sold the past many months. I would possibly start deploying the cash at that point of time. Although I would also say that at these levels, the levels which we saw about 3-4 days back, we were deploying a small amount.
Okay, understood that. Before I go ahead and understand where do you deploy your cash right now and what's the best strategy, I also wanted to ask you something that has been going on in a big debate way around all the experts have been discussing this, that whether we are entering a bear phase of the market with this kind of correction, because we've seen about 15% or so, or 20% also in some cases for some of the indices. So are we technically, yes, but then are we entering a bear market? What is your thought there?
No, see, when the markets move up, everyone gets so bullish. When the markets correct and come to these levels, again, people start talking of a bear market.
Yeah.
We are not talking of a long-term slowdown. We are talking of a slowdown, no doubt, because of the supply issues which I talked about, because of the sort of inflationary effect. There will be a slowdown. But I see this more as a temporary phenomena. Again, I'm talking of the next couple of quarters, maybe 3 or 4 quarters.
Okay.
I would say that is temporary, and it could possibly give an opportunity for a lot of people who could not buy earlier to buy at those lower levels.
Absolutely. Now, since you talked about having cash over the last few months, you've been advising your clients. Now is the time, if you think that the valuations have cooled off a bit, they were frothy earlier. Where is the best? What is the best way to deploy the cash right now in the markets?
No, I would look at a couple of sectors which will not really get too affected because of this slowdown. Like those sectors would be pharma, clearly, which has underperformed a bit in the last couple of months. Autos, I still see a decent amount of demand, which the companies are not able to supply because of the semiconductor shortage. I think that should get sorted out later. I'm quite bullish on infrastructure. Where exactly? The government also has a lot of focus on infrastructure. We've seen that in the last 2-3 years. I think that's going to continue. So the ancillaries, clearly auto is one of them because the HCV and excavators and all those will be required for infrastructure. Along with that, I'm also talking with the passenger cars. As well as far as infra is concerned, cement would
Yeah.
clearly be, one of the inputs. Where again, this sector has underperformed the last couple of months. I see that getting back on track.
Okay, you didn't talk about IT and banks at all. IT, which has actually emerged as one of the better performers in the last few sessions. We've also seen people have reached to that as a safe haven.
Okay.
And the banks that have actually fallen sharply and somehow are looking attractive at many places, some of the bigger banks also. So how are you looking at these two places?
In fact, I will not be buying them at this point of time. That's the reason I didn't mention it.
Okay.
IT again has moved up because clearly people see it as a safe haven at this point of time. And again, because the way the rupee has corrected, at least in the short term, it is positive for IT. But if you're talking of medium, it is the next, say, 4 to 6 quarters. I clearly see, better opportunities in other sectors as compared to IT. I'm not saying I'm bearish on IT, but then if I'm getting a better return in some other sectors, I would prefer to invest in those than IT. So IT is something which I'll possibly ignore. I'll possibly hold on whatever I have. I'll not buy fresh.
Okay. And what about some of these new age technology companies which have seen, recently very sharp fall from what they had, listed at? Are they any of those attracting you at these levels? Have they come to those valuations where one should look at? No.
No, surely not, because they were issued at very high valuations, and after the issue they doubled. So something which should have been quoting at X was issued at 2X, started quoting at 4X. So I think there's still a long way to go because quite a few of them have corrected just about 40-50% of the listed price, not the IPO price, but the listed price. So I suppose I'll wait for a while longer. There's only one stock in that which I think is worthwhile is Policy Bazaar.
Okay, understood. And how are you looking at the reopening trade, sir? Is that something that one should look at now that we are looking large part of COVID behind us and hopefully we don't see another wave coming sooner? Is that a pocket that one should now relook at?
So that's already played out because I don't see much of a juice left in that. I think it's already played out, including airlines. Airline stocks are clearly, have been playing out that for a while now. And like every post from 27th, we'll have the international flight starting off. But at the same time, look at the way the crude has moved. So the input costs have gone up. A decent amount of capacity will be coming to the market, which again means that the fares cannot really shoot up in tandem with the crude, which again means that the margins will not be there. So yes, it's a sentimental play, but on fundamentals, I really cannot recommend.
Okay. Are there any themes also that you're working with for the next 2 or 3 years perspective? If somebody has to look at that, these themes will become big and perhaps some may outperform going forward from here?
No, the sectors which I spoke about, I think are the sectors which will play out over the next 3 to 4 quarters as well as slightly longer term. So, at least as of now, those are the sectors I'm looking at from a medium to long term perspective.
Okay. With respect to market cap, are you advising anything to your clients? Like with mid cap and small caps correcting almost 40-50%, is there, something that one should look at over here at this point in time, or should one still stick with the large caps?
I think at this point of time, where we are, I think it's time to concentrate more on the large caps and the blue chips because they were corrected, they could correct a bit more. But then like I said, in case the market corrects another 10% from here, I'll be very comfortable. I think at those one should be again looking at the mid cap and possibly some of the small caps. Again, if you have done your research well, only then should you buy mid cap and small caps and not based on tips.
Right. What is your advice to all those investors who have entered the markets for the first time in the last 2 years? Now they're seeing this fall for the very, very first time in their lives. Is there a scare that they may now, even if the markets go up, they will be in a rush to pull out their money and go away? And what would your advice be to them?
So, I mean, see, basically, those who have invested without knowing where they're investing and why they're
Yeah.
investing, and have made money quite easily in the last 2 years, I think they are the people who will behave in this manner. Because if you don't
Okay.
know what you have bought, and you
Hmm.
have, and currently those that the portfolio is showing losses, so
Yeah.
typically what one does is wherever there are losses, they hold on. The profit making trades they exit in times like
Yeah.
these, and at lower levels they don't have the courage to buy further. And
Yes.
when you see a bounce back, they are the first ones to exit as soon as they get somewhere close to the close to their cost. So net in the next bull run, they're left
Yeah.
behind.
Absolutely. So, how can one make a portfolio which is going to be slightly protected in the current environment from the macro parameters? How does one hedge oneself against the rising inflation, the higher interest rate scenario that we'll be entering in very, very soon, and the slowing growth that we need to prepare ourselves for? More and more, agencies are now coming out with lower projections for FY22 and FY23, and with the war and the concerns that you talked about, that may also add on to the pressure of the already slowing growth that we were witnessing before the war too.
See, I mean, first of all, we should understand that we will not really get excellent returns for whatever we are buying right now
Okay.
in calendar year 2022. I
Hmm.
think we should start seeing returns only from next year. So I think we should have a medium to longer term approach when you are buying anything as of now. And I would suggest that about 40 to 60% of one's portfolio should typically be blue chips and large caps based on the risk profile. And the balance 60% to 40%. If your risk profile is such that you can take much higher risk, then have 60% in mid caps and small caps. If not, have 40% in that. So again, like I said, when you're buying mid caps and small caps, do some research.
Okay, understood that. Well, on that note, thank you so much, sir, for sharing these wonderful insights with all our viewers. Always a pleasure speaking with you and seeking all these insights on the markets. Hope to have you very, very soon back on Business Today. Thank you so much.
If you like the video, do like, comment, share and subscribe.